In today's video, we're going to walk through the TREC Third-Party Financing Addendum, Form number 4011, paragraph by paragraph. This is a critical form anytime a buyer is using financing to purchase a property. Before we dive into paragraph 1, there's something quick but important to point out. Make sure the property address is filled in at the top of the form. This links the financing terms directly to the correct contract and avoids any confusion later on. Now let's take a closer look at paragraph 1, type of financing and duty to apply and obtain approval. This is where you'll clearly indicate how the buyer plans to finance the purchase. And remember, this form only applies when financing is involved, not for cash deals. Let's break it down. Buyer's obligation to apply for financing. The paragraph starts by stating that the buyer must apply promptly for any loan selected below and make every reasonable effort to get it approved. That means submitting all documentation the lender asks for, tax returns, pay stubs, bank statements, etc. Responding quickly to underwriter conditions, not waiting until the last minute. This is not just about filling out a form. This clause creates a duty on the buyer to act in good faith and work toward approval. We have 7 different checkboxes. You'll select only the types of loans that apply to your buyer. Let's go through them. Paragraph 1A, conventional financing. This section is for standard mortgage loans that are not backed by a government entity, such as FHA, VA, or USDA. Most buyers use conventional loans through private lenders or banks. The paragraph allows space for 2 loans. 1, a first mortgage, most common. 2, an optional second mortgage used for down payment assistance or combo loans. To accurately complete the conventional loan section, you'll need the following information. Principal amount. This is the loan amount the buyer is borrowing. You can typically find this in the buyer's loan estimate or pre-approval letter. It should reflect what the lender is actually financing for the buyer, not the full purchase price if there's a down payment involved. Due in full, years. This is the total term of the loan. How many years until it's paid off? Common terms are 15, 20, or 30 years, and you'll find this on the loan estimate or any loan summary provided by the lender. The most frequently used is a 30-year term. Interest rate cap, %. This is the maximum interest rate the buyer agrees to accept for the first portion or all of the loan. Use a conservative estimate like 6.5% or 7.0% to allow flexibility in case the rate changes before closing. This protects the buyer and keeps the contract compliant. Number of years the rate applies. In most fixed rate loans, this will be the same as the full loan term, like 30 years. However, if the buyer is getting an ARM, adjustable rate mortgage, you'll only include how long the introductory rate is locked in, such as the first 5 or 7 years. Origination charge cap, %. This refers to the maximum percentage the buyer is willing to pay in loan origination charges. It's found on page 2 of the loan estimate under origination charges. Typical ranges are between 0.5% and 1.5% of the loan amount. Always round up slightly to avoid underestimating. If the buyer isn't getting a second lien, you would leave paragraph 2 blank and unchecked. Keep in mind, leave no blanks if the box is checked. TREC expects all fields to be filled. Don't assume the buyer is doing 20% down. Many conventional loans allow 3% or 5% down, so confirm before calculating financing amount. If the buyer is using an adjustable rate mortgage, the interest not to exceed and for the first year's blanks become especially important. Remember, confirm all loan details directly with the loan officer before completing any financing section. Guessing can lead to delays or contract issues. Paragraph 1B, Texas Veterans Loan. This section is used when the buyer is obtaining financing through the Texas Veterans Land Board, VLB, a program that offers competitive interest rates and low-cost loans to eligible Texas veterans and military members. What goes in the blanks? Loan amount. This is the principal amount the buyer will borrow through the VLB. It typically aligns with the purchase price minus any down payment. You'll get this number from the buyer's loan application or by contacting the loan officer working with the Veterans Land Board approved lender. Loan term. This is the length of the loan, typically 15 or 30 years, depending on the buyer's selection during the loan application. Confirm this directly with the lender or loan estimate. The interest rate is set and published by the Texas Veterans Land Board and can change weekly based on market conditions. You can find the current VLB interest rates here. Scroll to the interest rates section. They often list different rates for regular veterans, disabled veterans, and surviving spouses. Don't forget to also check the buyer's certificate of eligibility. The buyer may already have a certificate from the VLB indicating eligibility and prequalification details. Who qualifies for Texas Veterans Loans? Must be a resident of Texas, served at least 90 days active duty, received an honorable discharge, must be purchasing a primary residence in Texas. Keep in mind, this loan is separate from a VA loan. It is offered by the state of Texas, not the federal government. If the buyer is also using VA financing, you may need to check both paragraph 1B and 1D. Some buyers layer a VA guarantee with VLB financing. Don't guess. Always confirm with the buyer's lender before filling out this section. Paragraph 1C, FHA Insured Financing. This section applies when the buyer is using an FHA insured loan, a government-backed loan program designed for low to moderate income buyers with more lenient credit and down payment requirements. These loans are often attractive to first-time buyers. What goes in each blank? Here's how to complete this section and where to find the answers. Section. This refers to the specific FHA program. The most common is Section 203B for typical FHA home loans. Confirm with the loan officer or underwriter. Loan amount. This is the base loan amount, excluding financed MIP, mortgage insurance premium, found on the loan estimate under loan amount. Loan term, how many years? FHA loans are usually for 30 years, but 15-year options are also available. Confirm this on the loan estimate or pre-approval. Interest rate cap. This is the maximum interest rate the buyer agrees to accept for the first portion of the loan. Use a slightly higher than quoted estimate, for example, 6.75% or 7.0%, to provide a cushion. Pulled from the loan estimate or lender's quote. Number of years interest rate, usually the same as the full term, for example, 30 years, unless it's an FHA ARM. Ask the lender if unsure, most are fixed rate. Origination charge cap, found on page 2 of the loan estimate under origination charges. Typically ranges from 0.5% to 1.5%. Round up slightly to allow for lender changes. Where to get this information? Loan estimate, page 1, loan amount, term, interest rate. Page 2, origination charges. Pre-approval letter. May include loan type and base loan amount, lender or loan officer. Best source for confirming the FHA section, MIP exclusions, and other underwriting specifics. Special notes for FHA transactions. FHA loans require a property to meet minimum condition standards. Buyers must receive an FHA appraisal and certificate of reasonable value. Paragraph 4 of this addendum, FHA VA required provision, becomes mandatory when FHA financing is involved. Unlike conventional loans, FHA loans come with upfront MIP, which may be financed, and monthly mortgage insurance, even if the buyer puts down 20%. Pro tip for agents. When using FHA, be mindful of FHA appraisal timelines and repairs. Always confirm whether MIP is financed or paid up front. Help buyers understand mortgage insurance is not cancelable on FHA loans originated after June 2013, unless large down payment. Paragraph 1DV, a guaranteed financing. This section is used when the buyer is obtaining a VA loan, which is a zero-down mortgage option available to eligible veterans, active duty service members, and surviving spouses. VA loans are backed by the U.S. Department of Veterans Affairs and do not require monthly mortgage insurance. What goes in each blank and where to find it? Loan amount. This is the base loan amount, excluding any finance VA funding fee. You'll find this on the loan estimate or from the buyer's loan officer. Loan term. Most VA loans are 30-year fixed, but terms can also be 15 or 20 years. Confirm this with the loan estimate or pre-approval letter. Interest rate cap. This is the maximum interest rate the buyer is agreeing to accept. Use a slightly conservative estimate, typically around 6.5% to 7.5%, pulled from the loan estimate or lender quote. Number of years interest rate applies. In most VA loans, this will match the full loan term, for example, 30 years. If using an adjustable rate VA loan, enter the number of years the initial rate is fixed. Origination charge cap. This refers to the origination fee, usually capped at 1% by VA guidelines. Found on page 2 of the loan estimate under origination charges. Enter no more than 1% unless justified and disclosed per VA rules. You can also check loan officer or VA specialist or via certificate of eligibility, which confirms borrower eligibility and may note if they are funding fee exempt, for example, disabled veterans. What are the special VA loan considerations? VA loans do not require a down payment up to conforming limits. No monthly mortgage insurance, a major advantage over FHA. A funding fee is usually financed into the loan unless the borrower is exempt, for example, disabled veterans. Appraisal must meet VA minimum property requirements, meaning when a buyer uses a VA loan, the appraiser checks more than just value. The home must also meet VA minimum property requirements, MPRs, standards for safety, structural soundness, and livability. If the property has issues like peeling paint, roof leaks, broken HVAC, missing handrails, the VA appraiser can require repairs before the loan is approved. Bottom line, even if the value is fine, the loan won't move forward until the home meets VA habitability standards. The VA loan program limits origination charges to 1%, which is why this blank is often filled in as 1%. When dealing with a VA buyer, don't ask for a down payment unless the sales price exceeds the appraised value. Make sure you understand paragraph 4 of the Third-Party Financing Addendum, which protects VA buyers if the appraisal is low. Know that if the property doesn't appraise, the buyer can walk away without penalty unless they agree to pay the difference in cash. Paragraph 1E USDA Guaranteed Financing. This paragraph applies when the buyer is using a USDA loan, a government-backed mortgage for low to moderate income borrowers buying homes in rural or designated suburban areas. USDA loans offer 100% financing, no down payment, and low interest rates. To properly complete the USDA Guaranteed Financing section in paragraph 1E, agents will need to fill in 5 specific blanks based on details provided by the buyer's lender or loan estimate. First, enter the loan amount, which should reflect the base loan amount, excluding any financed USDA funding fee. This amount is typically 100% of the sales price since USDA loans are designed for zero down payment financing. You can find this figure on the buyer's loan estimate or confirm it directly with the loan officer. Next, complete the loan term, which for USDA loans is almost always a 30-year fixed rate loan. You can verify this on the loan estimate or by checking with the lender. USDA does not offer short-term or adjustable rate options under its guaranteed program. For the interest rate cap, enter the highest interest rate the buyer is willing to accept. This should be a conservative estimate to protect the buyer in case rates fluctuate before closing, typically between 6.5% and 7.5%. This information can also be confirmed through the lender or loan estimate. Then indicate the number of years the rate applies. In almost all USDA loans, this will match the full loan term, usually 30 years. However, always double check with the lender, especially if an uncommon program is being used. Finally, complete the origination charge cap. This is the maximum fee the buyer agrees to pay for the lender's origination services. You'll find this on page 2 of the loan estimate under the loan costs section. For USDA loans, federal rules cap the lender's origination fee at 1% of the loan amount. You can also check USDA loan eligibility portal to confirm if the property qualifies. Important USDA loan notes for agents. USDA loans require no down payment and are for primary residences only. The property must be located in a USDA eligible area. Use the USDA map tool to confirm. Borrowers must meet income limits, which vary by county and household size. USDA loans include a 1% upfront guarantee fee, often financed into the loan, and annual mortgage insurance. The lender may only charge up to 1% in origination fees under USDA rules. Pro tip for agents: if you're not sure if it's a USDA loan, check if there's zero down but not a VA buyer. Ask the lender or buyer if the property is in a USDA eligible area. Look for references to Rural Housing Service or Section 502 guaranteed loan in the lender paperwork. Paragraph 1F reverse mortgage financing. This section applies when a buyer is purchasing a home using a reverse mortgage loan, also known as a home equity conversion mortgage, HECM. These loans are primarily used by individuals 62 or older who are downsizing or relocating using equity from a previous home and who do not want to make monthly mortgage payments. Unlike traditional mortgages, reverse mortgages don't have a set loan term. Instead, the loan becomes due when the borrower moves out permanently, sells the home, or passes away. What this paragraph requires you to fill out: loan amount. Enter the original principal amount of the reverse mortgage, excluding any financed PMI or other costs. Get this from the lender or reverse mortgage estimate sheet. Interest rate cap, percentage per annum. This is the maximum allowable interest rate the buyer agrees to accept. If the reverse mortgage is fixed rate, this would be the actual rate. If it's an adjustable rate, this is the maximum it can increase to. Confirm with the lender based on the specific reverse product being used. Number of years interest rate applies. This is not the full loan term. It refers to how long the interest rate listed above is guaranteed or fixed. For fixed rate loans, it might be 30 years. For adjustable rate loans, it might be 5 or 10 years, depending on the fixed period before the rate adjusts. Clarify with the lender if unsure, especially for ARM. Origination charge cap, percentage of the loan. This refers to the maximum percentage of the loan the buyer is willing to pay in origination charges. Reverse mortgages can have higher fees. FHA HECM, for example, cap lender origination fees at $6,000, but this may vary. Check the loan estimate or lender's reverse mortgage fee breakdown. FHA Insured checkbox. You must indicate whether the reverse mortgage loan will or will not be FHA insured. Most reverse mortgages are FHA-backed HECM, but some buyers may use proprietary, non-FHA reverse loans. Confirm with the loan officer or in the loan program details. Notes for agents. Reverse mortgages are only for primary residences, and borrowers must be 62 plus. Buyer must complete HUD-approved counseling before loan closing. Property must meet FHA minimum property standards if FHA insured. There is no monthly mortgage payment, but the buyer must still pay property taxes, insurance, and maintenance. Tip: if you're filling out this paragraph and don't know how long the interest rate is fixed or whether it's FHA insured, pause and contact the lender. These details are crucial for compliance and for protecting your buyer. Paragraph 1G, other financing. This section is used when the buyer is obtaining a type of loan not covered in the previous options. For example, seller financing, private or hard money loans, bridge loans, owner carried notes, creative financing structures. Because this is a catch-all section, the details must be very specific and are entirely based on the custom terms of the financing agreement. To complete this paragraph, you'll need to include the name of the lender, which could be a person, business, investor, or the seller themselves. You must then specify the total principal amount the buyer is borrowing, along with how many years the loan will run before it must be paid in full. This is the full term of the loan, such as 5 years, 15 years, or 30 years, depending on the financing agreement. Next, you'll enter the maximum interest rate the buyer is agreeing to. If the loan is fixed rate, use that number directly. If it's adjustable, input the maximum rate that could be charged during the initial term. Then include how many years that rate will apply, typically matching the loan term unless it's an ARM with a fixed introductory period. You'll also need to state the maximum percentage the lender is allowed to charge in origination fees, since private and seller loans can vary significantly. Finally, this paragraph includes an important checkbox where the buyer either does or does not waive their right to terminate under paragraph 2B of the addendum, which we will discuss more in part 2. If the buyer does not waive their rights, they can still back out of the contract if financing falls through. But if they waive their rights, they agree to proceed regardless of whether the loan is ultimately approved. This choice can have serious implications and should be made carefully in consultation with the buyer. Where to get the info for paragraph 1G? Name of lender, ask the buyer or check the financing agreement. Loan amount, provided by the lender or shown in the loan terms. Loan term years, listed in the promissory note or loan proposal. Interest rate, quoted by the lender or written in the loan terms. Years rate applies, usually the same as the loan term. Confirm with lender. Origination charges, ask lender or refer to their fee schedule. Waiver of rights, 2B, buyer decides, explain both options clearly. Pro tip: since this section allows for non-traditional financing, there may be no loan estimate like you'd have with conventional or FHA VA loans. That's why it's crucial to get written loan terms up front, work closely with the lender or seller offering financing, ensure your buyer understands the risk, especially if they waive financing contingency. And that wraps up part 1 of our breakdown of the TREC Third-Party Financing Addendum, Form 4011. In this section, we've covered paragraph 1, Options A through G, which detail every major financing type your buyer might use: conventional, government-backed, reverse mortgages, and even creative or private loans. The key takeaway? You must fill out only what applies, but if a box is checked, every blank must be completed accurately. The information must come directly from the lender or written financing terms. And as always, your buyer should understand the timeline and risks tied to each type of financing. In part 2, we'll break down paragraphs 2 through 5, including how to handle buyer approval, property approval, security instruments, FHA, VA protections, and disclosure permissions. Whether you're writing an offer or reviewing one, understanding this form protects both your client and the deal. If you have questions, feel free to contact our office at 888-228-4535, Monday, Friday, 9 to 5 CST. And if you found this helpful, be sure to like, subscribe, and join us for part 2.